We're actually overweight the Philippines and Indonesia. It's been a bit of a rough ride to start this year, to be clear. But we think that there are that attractive underlying bottom-up fundamentals are being currently dominated by macro concerns, largely having to do with currency and associated fixed income flows. But that the underlying equity story is actually pretty attractive. I'll just give you one statistic. Actually, both markets are trading around 10 times earnings, over 2 standard deviations, like 2.5 standard deviations below their long. Yeah, so the value is there, and they tend to have a much greater domestic demand content. So if you're worried about kind of global uncertainty and what might happen in terms of the global economy in general, slowing, yeah, they've got some insulation in terms of that domestic demand story. Yeah. And if you look at, for example, the banks, which are a very large part of the index weighting, 60% or more in case of Indonesia and about 30% in the case of the Philippines, the banks are generally very high ROE. The Indonesian banks have an ROE of about 18% or thereabouts. So there are some pushback on that. There's been some crowding. There's been some concerns about short-term profit growth slowing because of tight domestic liquidity conditions. But for those investors who can take a longer-term view, there's definitely some value on the table for some very good assets. So we're sort of thinking that we want to kind of weather the near-term macro bumps with a view towards having a longer-term strategic interest. Now, lastly, I just would note that Thailand is probably our least favored market there, largely because a number of reasons. Its first valuation is much higher, sort of mid to high teens, and relative to its own range, it's higher. We also think that the underlying growth trajectory is not as compelling in Thailand, and we're not as optimistic about the currency. So, it's not like we're huge bears on it, but just in terms of relative pecking order, we would place the markets I just mentioned, along with Singapore, which has just had very good, steady 80 delivery by the banks, including DBS yesterday. And there's a lot of return of capital, which is going on. That's an emerging theme around not just ASEAN region, but the region more broadly. So you're getting stable earnings as well as high cash return to shareholders is something that we like in a market like Singapore.
Tim, I've got to ask you, on the macro and Indonesia, right? When you take a look at what President Prabowo has been doing, right? And we've both been around long enough to remember this, right? There was a time when the Indonesian military was incredibly influential in politics, right? The military in politics as well as in business. And, there was a lot of criticism of that crowded out the private sector as well. You worried that it's returning to those days?
Well, I think the market is pricing some concern in that regard. But I think that it may be overly negative. And I'll just give you one example. So Prabowo has been has said that he would like to improve or increase the rate of economic growth, cited 8%, whether that's a real goal or not, but above the sort of roughly 5 to 5.5% that Indonesia is currently growing at, and to do so by greater fiscal stimulus and increasing the debt level. Now, those sound like alarm bells to anyone who's been around the global the Asian financial crisis, which you and I both remember. But we have to understand that the context of this is that Indonesia, by law, has a 3% of GDP per annum fiscal deficit. So there's a ceiling on that, number one. And number two, the current debt to GDP is about 40%. Now, so if you raise debt to GDP from 40% to say 50%, it sounds like you're being fiscally profligate, but in actual fact, that's eminently doable given Indonesia's macro circumstances. So I think that the market may be overly harshly judging those intentions on the part of President Prabowo because of the residual scar tissue from the Asian financial crisis. So fundamentally, I think that it's probably somewhat better than the market's discounting.
Although I have to note that, that 3% deficit as a percentage of GDP, that cap is a little bit of a red herring because traditionally and historically, we both know, right, that a lot of the funding goes through state companies.
It could do, and there's some discussion of state companies. Danatara is currently topical, but I still don't think it obviates or completely disembodies the broader argument that Indonesia has actually been pretty fiscally sound. I think the real issue in the market is the currency. Really, the chain of events is that the currency has to stabilize versus the dollar in order for Bank Indonesia to start to moderate rates and to ease domestic liquidity, and that will flow through to the banks, and that'll generate growth and so forth. So I think all eyes really are on the dollar. Okay. And sadly, I think the dollar is going to be stronger in the near term for longer. But once we can hopefully get through that, and maybe we're looking more into the second half of the year than the first half, then I think that the stars will align to a better extent.